Day Trading for Beginners. Technical Analysis Explained. Written by Giovanni Rigters. Narrated by Ron Garner. Introduction. Who wants to wait decades before they can enjoy the fruits of their labor? Why invest in boring companies that take forever to make you wealthy? There is a faster way to make money and enjoy a lavish lifestyle. This is where day trading comes to the forefront. Many self-determined and confident day traders have made millions in the stock market. They are their own boss, decide when and where they work, and can take vacations when they feel like it without having to request it. Day traders can make thousands to tens of thousands of dollars in a matter of minutes or hours in a day. Multiply those figures over a yearly period, and it's very clear to see why this lucrative venture piques the interest of many investors. The stock market presents frequent opportunities for investors to make money. Now, this all sounds great and is definitely possible, but let's get back to reality. For every day trader who is able to rake in the money, there are thousands of other investors who tried, failed, and lost a ton of money in the process. Day trading is not for the faint of heart. It can be quite stressful, and it will take some time to get good at trading. Sitting or standing in front of monitors in a quiet setting every day, looking at stock charts and analyzing performance might not be as fun as you think it can be. I say all this to say that day trading is not for everyone. It is mentally hard, and only a select few are built for it. But if you so happen to be one of the select few, then get ready for the roller coaster ride that is day trading. Chapter 1. Day Trading Explained. Day traders are traders who buy and sell investments in a matter of minutes or hours. However, a lot more goes on than just buying and selling. As a trader, you also need to be able to analyze market data and make calculated decisions based on your accumulated data. Besides day traders, there are also swing traders. These traders don't buy and sell in a matter of minutes or hours, but days or even weeks. As a swing trader, you basically take a slightly longer-term approach to trade, but you still go through many of the same steps a day trader goes through when making trading decisions. Successful traders. Every day trader is unique with their own strategies, but to become a successful trader, you need to possess the following 4 skills or work on getting them. The most important skill you need to possess is a mindset of success. This means that you need to be optimistic and learn from your mistakes. There will be many times where a trade will not work in your favor. Instead of looking at these trades as failures, you need to look at them as learning experiences and adjust your trading strategy if necessary. There will be occasions where you will have bad trading days, and instead of taking it personally, it's best to stop trading for the day. Reevaluate your trading positions and pick it up again the next trading day. The second skill you need to possess is to be able to be as unemotional and systematic as possible about day trading. The majority of new day traders have no clue what they are doing and trade on their emotions, hunches, and stock tips they receive. Emotional trading will leave you stressed out when you start to lose money and greedy when you are generating unrealized profits. When it's time to sell shares and cash in your profits, an emotional trader will stay in the market far too long and eventually see their profits whittled down. The next skill you need to have as a day trader is to be an analyst. Instead of following what other day traders are doing or trading based on hot stock tips, you need to be able to analyze charts, add your indicators, support and resistance levels, and rely on your system of success. This brings me to the last skill you need to have, which is a systematic approach to day trading. The benefit of relying on a system is that you have a specific guideline to abide by. If you stick to a plan, you will also be able to take your emotion out of trading. A systematic approach lays down the foundation on buying and selling, the amount of risk you should take per trade for profit, and which tools you use to evaluate investments. Your systematic approach is how you will trade as a disciplined trader using technical analysis. Chapter 2: Uncovering the Basics. Before we jump into the nuts and bolts of technical analysis, we need to get familiar with some of the terms used in the day trading community. This is by far not an exhaustive list of all terms, but it will set you on the right path. In the investing world, you will come across both fundamental and technical analysis. Fundamental analysis is the art of analyzing the metrics of a company trading on the stock market. Long-term and value investors primarily use fundamental analysis to decide which company's shares to buy by analyzing a company's book value, revenues, debt, return on equity, price-to-earnings ratio, and more. Value investors use fundamental analysis to figure out what a company is worth and if it is trading under its value. Technical analysis is used to evaluate investments on charts by looking at patterns, trends, and prices. Day traders then use their analysis skills to decide when to buy or sell investments for a profit. Intraday trading is the term used when traders trade during the same day. Traditional day traders stick to technical analysis, and value investors stick to fundamental analysis. However, there are value investors who use technical analysis to decide when to buy at the lowest price available, and there are some day traders who look at fundamental analysis and pay attention to when companies announce financial results, which could have positive or negative impact on the stock's performance. All charts have a specific interval or time frame that can be changed. You could look at charts at a 1-minute, 15-minute, 30-minute, 1-day time frame, and more. This means you can get as detailed as you want in analyzing charts. These charts also contain volume bars at the bottom of the chart. Hovering over the bars will show how much trading has occurred in that time frame. I like to trade stocks that are highly liquid, meaning there are enough shares being traded among buyers and sellers. I like to stick to stocks that trade more than 1 million shares per day. You don't want to be in a situation where you have bought shares that you are ready to sell, but there are not enough buyers in the market, which ends with you selling your shares for an even lower amount just to be able to match the ask price of the available sellers. Different charts you will run into: bar charts, line charts, area charts, and candlestick charts. Line and area charts show you the closing prices at a select time period. So, if you have an interval set by day, your chart will generate a line or area chart showing you close prices by day. Bar charts show a bit more information compared to line and area charts. Bar charts show the open, close, high, and low trading prices per bar. By far, the most used chart type by day traders is the candlestick chart. Reason for this is that candlesticks allow day traders to notice patterns which cannot be identified in line, bar, or area charts. Each candlestick shows you the open and close price. Additionally, you also see the high and low trading prices during the trading time frame. If a stock closed higher than an open, you will see a white or green rectangle, also called the body. The vertical lines above and below the body are the wicks, or shadows. This shows the highest and lowest the price was trading at. If a stock closed lower than its opening price, you will see a black or red body. For example, A stock opened at $20 and closed at $30. Throughout the day, the stock dropped all the way down to $15 and went up all the way to $34 before it closed at $30. Looking at the candlestick for this day, there will be a green body from $20 to $30. Above and below will be wicks. The lower wick will hit $15 and a higher wick will hit $34. Multiple screens and charts. Day traders like to use multiple screens, not to look cool, but to be able to have a pulse on multiple investments they are tracking. However, multiple screens are not needed to get started. It's recommended, however, to pull up multiple candlestick charts showing different time frames, which could reveal patterns and trends, and adding overlays like moving averages are also frequently used. Moving averages are lines which are placed on your stock charts. These moving averages smooth out the erratic swings of the candlesticks. I like to have 3 different candlestick charts, one at 1 minute, 30 minute, and 1 day. Going long and short selling. When buying or selling investments, you can either go long or go short. Going long means you bought an investment which you believe will go up in value in the future, which you will then sell for a profit. Short selling, or going short, means selling investments at one price and buying them back at a lower price. The difference is your profit. This can be quite confusing, so let's unpack this with an example. XYZ stock has been trading lower for the past few weeks. You believe you can capitalize on this trend. You borrow 100 shares from your broker and sell them at $10 each for a total of $1,000. The stock drops to $5 and you buy back 100 shares you borrowed for $500. You return the 100 borrowed shares and keep the $500 profit. Transaction fees not accounted for. As a beginner in day trading, it's best to start investing by going long because this is the easiest concept to understand, quick to get into, and less risky compared to short selling. When you go long, you only risk losing the money you invested going long. So, if you bought 100 shares at $5 for a total of $500, you're only risking your investment of $500. With short selling, however, your risk is unlimited. Let's say you borrowed 200 shares and sold these shares at $5 apiece for $1,000, expecting the price of the stock to drop below $5 in order to make a profit. Instead of trending down, the stock price reverses and trends upwards. Your losses on this trade have no limit because the stock could trade at $6, $7, $10, or even higher. If the stock ended trading at $10, you have to return the 200 borrowed shares. You will have to buy them at $10 apiece for a total of $2,000. Not only have you lost your $1,000 investment, you also owe your broker an additional $1,000. That being said, you still want to keep short selling in the back of your pocket to pull it out after you get comfortable going long. If you only go long, you will miss out on opportunities to make money. Traders in the market. As a day trader, you will be in the market with other day traders. However, you will also trade against high-frequency traders, institutions, financial traders, and emotional traders. High-frequency trading is trading with computers who buy and sell large amounts of investments in a matter of a fraction of a second. The sheer volume of stocks allow high-frequency trading to make millions. As a day trader, you should be aware of these investors and traders, but not be worried about them. As long as you stick to your game plan, you will have success. The trend is your friend. An investment can trend in one of three directions: up, down, or sideways. You can see this trend on stock charts by looking at the candlesticks. However, using moving averages gives you a clearer picture of the trend. A stock which moves in one direction will continue to trend in that direction unless there are any indicators that says otherwise. There are multiple reasons a trend might change: less than stellar financial term, bad company news, declining economy, etc. Day traders don't really care why this happens as long as they can spot the trend reversal and capitalize on it. Chapter 3: Technical Analysis. Indicators. Indicators allow you to spot trends, swings, and patterns. Every day trader has their favorite indicators they apply to their charts. Some day traders like to load up their charts with a multitude of indicators. I like to keep my chart simple and clean by only applying a few indicators. There are many indicators to choose from, but I limit my charts to the following: 20 EMA, 100 EMA, slow stochastics, MACD. MA stands for moving average, and EMA stands for exponential moving average. A moving average takes the average of the trailing closing prices dependent on how many prices you want to look at. A 20 MA will look at the average of the last 20 closing prices. Moving averages give us a great view of where a stock is trending. I use the EMA instead of the MA. The EMA, or exponential moving average, puts more weight towards the recent close prices. As a day trader, I like to put more weight toward the recent price data as this is what I base my buying decisions on. I use the 100 EMA overlay to show the longer 100-day average trend and the 20 EMA to show the current more volatile trend. Just by having these two indicators alone, I can quickly tell if the stock I'm analyzing is trending up, down, or sideways by comparing the 100 EMA to the 20 EMA. This is the longer time frame analysis. If the 20 EMA line is below the 100 EMA line, the chart tells me that the stock is trending lower. If, however, the 20 EMA line is above the 100 EMA, the stock is in an upward trend. I continue by focusing on the 20 EMA and see where it's trending compared to the candlesticks. This is the short time frame analysis. If the 20 EMA is below the candlesticks, we are looking at an upward trend. And if the 20 EMA is above the candlesticks, the stock is trending downward. If the 20 EMA is in line with the candlesticks, then the stock is trending sideways. The first two indicators tell me if I should go long, short, or hold off on investing. I never invest on a hunch, and I don't have a gamble mindset when it comes to investing. I never trade on sideways charts patterns that don't show any types of trend direction, either up or down. The best setup I traded as a beginner was an upward trend, which continuously achieved higher highs and higher lows. With this setup, the 20 EMA will be above the 100 EMA. The 20 EMA will be below the candlesticks. This setup allows me to go long. Slow stochastics. This indicator displays when a stock has been overbought or oversold. As a day trader, we can position ourselves to take advantage of these two conditions. Many times, emotional investors panic and start selling at a rapid pace. This can cause the stock to go into an oversold condition, under 20 on the slow stochastics chart. Other situations might cause investors to become overly optimistic and greedy, pushing the price of the stock up into an overbought condition, above the 80 line on the slow stochastic chart. So, how can we make this work in our advantage? As a trader, I only buy when stocks bounce back from being oversold and only sell or take profits when a stock is in an overbought condition about to reverse. You can never predict how far a stock will rise or drop. That's why I buy or sell right when I see the trend reverse when a stock is overbought or oversold. MACD. The last indicator I use is the MACD, pronounced MACD, which stands for Moving Averages Convergence Divergence. Stocks have a peculiar rhythm where they sway up and down like waves in an ocean. The MACD allows me to uncover this rhythm, allowing me to locate my entrance and exit strategy for a stock. The red and green bars in the MACD show me the momentum of the stock. There are also two lines on the MACD, different colors. If the lines cross each other, it shows me that the momentum has changed. I like to hover my cursor over the slow stochastics and then compare it to the momentum in the MACD, and then look at the candlesticks. Indicators, however, will never be a sure thing. Indicators are just guidelines you use in order to do technical analysis. Some notable indicators that investors also use are the Bollinger Bands and the Fibonacci retracement levels. Chapter 4. Advanced Technical Analysis. After setting up my indicators, I continue by drawing support and resistance lines on my charts. On a chart, you will notice peculiar price points which show a lot of trading activity and no break through these price points. For example, you might see that stock XYZ keeps dropping, but whenever it hits $1, the price increases. For some reason, the price won't go below $1. This is called a support level of stock XYZ. If ABC company has been trending upwards, but does not break through its upward barrier at $3 after it has hit against it a couple of times, this is the stock's resistance level. Stocks eventually do potentially break through their support or resistance levels after they have been tested a couple of times. There are many reasons why support and resistance levels form. Sometimes investors have specific price points where they want to sell or buy. The previous day's close price can also act like a resistance or support level. When investors miss a specific trade price point to enter or exit an order, they will remember that specific price point, so they wait for the stock to hit that price again before taking action. As day traders, we locate these support and resistance levels, which give us a clear indication on entry and exit points. Candlestick Analysis. After analyzing indicators and locating support and resistance levels, it's time to look at the candlesticks. It's best to analyze a series of candlesticks, but you can also derive a lot of information from one candlestick. A couple of candlestick types I pay attention to that give me critical information. Long candlestick, short candlestick, doji, hammer, shooting star. Long candlestick. This shows intense buying and selling activity. Short candlestick. Shows slow to no price movement. Doji. This candlestick looks like a plus sign. It tells me that the stock could trend in any direction. There is no trend to be noticed because the stock opened and closed at the same or slightly different price. Hammer. A small body with a very long lower wick. This tells me that there has been a significant drop in price followed by a lot of buying activity that pushed the price back up. This usually happens when a stock hits its support level. Shooting star. A reversed hammer. This shows me there has been a big push to sell to get the price closer to the opening price after reaching its high. This candlestick is usually seen close to a resistance level. Taking these candlesticks in conjunction with previous sticks on the chart will allow you to spot interesting information. Level 2 quotes. There is a quote system which allows you to see real-time quotes on bid and ask prices, which is called Level 2. Buyers' bid prices and sellers' ask prices give you a deeper level of stock analysis, which can show you where there might be a congregation of buyers or sellers at a specific price point, which allows you to plan your buy or sell decision. If, for example, you want to sell shares you've been holding on for a couple of hours at a specific price of $50, but you noticed that looking at the Level 2 quote, there is a large congestion of sellers at $50. You might decide to lower your sell price to $49.99. This guarantees that your order will be filled before all the sellers at the $50 sell price. A Level 2 quote lists the different exchanges and also the size of the buy or sell order. Supply and demand is what a Level 2 quote will show you. If there are more buyers than sellers, the price of the stock will more than likely go up. Vice versa, more sellers than buyers means the price of the stock will go down. Chapter 5. Managing Risk. Whenever I enter into a trade, I already know how much risk I'm willing to take for my potential reward. I use the previous stock support level as my exit strategy. I like to put my stop order right below the support level, as stocks do tend to get oversold around the support level. You can notice this by looking at lower wicks as support levels. I use resistance levels to take a portion of profits by selling if it hits that price point. If the stock continues to trend upwards to a new resistance level, I update my previous support exit strategy. By putting my stop order right below my support level, I take out emotions out of my trade. If the risk is greater than the reward, I skip the trade. If I risk losing $1 and only would make 20 cents, then that's not the trade for me. My reward needs to be at least double my risk. This also goes for my trading account. I would never risk putting all my money in one trade, no matter how small or big the account is. I make sure to have at least 4 different trades if I had a $2,000 account. I would not put my eggs in one basket, no matter how good a trade looks. Day trader tips. Broker fees. Always do the research on broker fees. As a new trader, you want to be familiar with the fee structure of your broker. Transaction fees can add up fast, and some brokers also charge you a fee if your account is inactive. Favorite indicators. I gave you a list of indicators that I use, but feel free to experiment with additional indicators. Every day trader has their favorite indicators, but keep in mind that the indicators alone does not make for a great day trader. Level 2 quotes. Make sure to incorporate a Level 2 quote on your screen and start to get into the habit of analyzing this. I skipped looking at Level 2 quotes when I first started trading, but it contains a great information in the form of buy and ask orders which you cannot see on charts. Paper trading. I never used paper trading when I first started trading. I always felt that paper trading only gives you a part of the experience. I jumped in the market with my own money from the start, but paper trading is a good way to get familiar with day trading, fine-tuning your systematic approach, and test different strategies. Conclusion. Patience and going through the learning process while improving on your trading skills constantly is what you should expect starting out. It's unrealistic and dangerous to think that you will make fast money without the skills and time put in. The techniques talked about in this book will set you on the path to get started, but never hesitate to do additional research online on topics that might be unfamiliar to you. Starting out day trading might feel weird, exciting, and stressful, but once you have a couple of trades under your belt, you will get more comfortable and come up with your own techniques to make trading more enjoyable. To get good at day trading takes time, and not every trade will be a success. There will be many ups and downs, but if you keep pushing yourself and learn from your mistakes, you will make healthy progress. Thank you. I would like to thank you from the bottom of my heart for coming along with me on this day trading journey. There are many books out there, but you decided to give this one a chance. If you like this book, then I need your help. Please take a moment to leave an honest review for this book. This feedback gives me a good understanding of the kinds of books and topics readers want to read about, and it will also give my book more visibility. Leaving a review takes less than 1 minute and is much appreciated. Important disclaimer. This book is presented solely for educational and entertainment purposes. The author is not offering it as legal, accounting, financial, investment, or other professional services advice. The content of this book is the sole expression and opinion of its author. It is not a recommendation to purchase or sell equity, stocks, or securities of any of the companies or investments herein discussed. The author cannot guarantee the accuracy of the information contained herein. The author shall not be held liable for any physical, psychological, emotional, financial, or commercial damages, including, but not limited to, special, incidental, consequential, or other damages. You are responsible for your own choices, actions, and results. Please consult with a competent tax and/or investment professional for investment and tax advice. Other titles by Giovanni Rigters. 50 Tips on Saving Money. Ever have a feeling that you never have enough money when needed? Would you like to have some extra cash to buy what you feel like? Well, in this book, we will look at 50 different tips allowing you to have some extra cash in your pocket and bank account. Smart investors create wealth. It's never too early to start your journey towards accumulating wealth. No one wants to work for the rest of their life. I will show you what wealthy people have known for centuries on how to not only create wealth, but also maintain it so you can pass it down. The end.